I just bought this stock, BERY Global. BERY makes a bunch of plastic products. Basically everything that's a container, or some stuff in medical, they make it. Bottles, vials, bags, cabs, canisters, drinking cups, everything. They make a lot of stuff. And that's spread across a variety of industries. The stock is currently massively overlooked, currently yielding 1 billion in free cash flow, on a 7 billion market cap, and currently massively buying back shares. Today I'm gonna explain you why I bought the stock. First of all, BERY is positioned very globally, but they're still underrepresented in emerging markets, and I think this is where especially growth opportunities lie for BERY. And here they're also investing heavily. Only half their capex is used for maintenance, so all the other capex is going straight into growth. And BERY so far has proven that they're able to grow. Since 2015, they have been growing at 17% CAGR for a plastic company. Yes, there has been an acquisition. In 2019, they had a big acquisition. They bought RPC Global for $6.5 billion. That is basically the market cap of BERY, so they had a huge investment here. But even without these investments, they have shown that they are able to grow. And not only revenue-wise, also when it comes to free cash flow. And they have done this with minimal dilution. So you have the growth of a tech company here, but without the dilution of one. 10% free cash flow CAGR in the plastic industry is amazing. And remember, even if a downturn happens, they have so many products over so many categories that it's not gonna impact them much. They have a fairly weak year right now, but we can see even in a weak year, they're still able to keep margins. Earnings per share only down by 7%, while revenue is down 11%. And this is what I like in a company, that they can grow during the good times, and even if there are hard times and their revenue declines, their margins don't get pressured down. We can see profit margins are fairly stable to rising in the long term. And since they had the acquisition in 2019, they have already paid down 3 billion in debt. That is nearly half their market cap. Imagine if they would have bought back shares with that, there would have been half the share count today. So once they stop deleveraging as much, and I think they're slowly reaching the end of deleveraging, they're probably gonna put that more into share buybacks. We can see 9 billion of net debt, they make around 1 billion in free cash right now, that would be only a 9 multiple, that is not a lot. Especially because they don't put a lot of free cash flow into the dividend right now. They make $8.53 per share and only pay out $1. So they have a lot of cash to grow, acquire, buy back shares or pay down debt. While they expect free cash flow to be at 800 million this financial year, I think that is fairly conservative. And even with that, we can see how much this company can buy back. They plan to spend 600 million in total, and that would already be 8% of shares. And they're doing this during a weak year, I gotta remind you. This is a weak year for BERY, and their debt maturity is also not much of an issue. We can see some debt matures in 2024, but not a lot. They can pay that down easily. Only in 2026 they will have to probably refinance some debt. But even then, that will not be a lot. They can easily accumulate cash until then and pay down a bunch of that. We can see they're not over leveraged. And the market is also not asking for a high interest rate on bonds. We can see a bond that matures in 2025 at BERY is currently trading at 4.49%. That is not a high yield. So if they really fall to 800 million, which I do not expect, even if it happens, it will probably recover in the next 2 years. We assume a 9% growth rate, 7% after that, 15 multiple, not a lot for a company that is growing and buying back shares aggressively, which is not highly leveraged. Those are conservative assumptions. They could currently just buy back shares and already achieve a 9% growth rate. No organic growth, just share buybacks. 22% payout ratio with little deduction due to taxes. Then we would come to 90.44 a share, which is a 53% discount to what it's trading at today. These are conservative assumptions. So what if BERY grows even faster? 12% for the next 5 years, 10% after that, 20 multiple. This is what I think will not really happen. The market is kind of scared of BERY because it's in the plastic industry. So I do not believe it will give it a 20 multiple. But this is just an optimistic scenario. If this would happen, $147 per share. Now what if it would go worse? Maybe free cash flow goes very low for long term. 6% growth rate, 5% after that, just from share buybacks. 10 multiple for a company that is slowly growing, not a lot off the current value. This is what I like about BERY. It is a growing company, lots of cash flow, very dominant in its industry, trading at a very cheap valuation. In fact, BERY's stock has moved nowhere since 2017. Free cash flow per share since then has nearly doubled. This is why I think BERY is just so undervalued right now. This is why I'm happy to have it in my portfolio. What do you think about BERY? Write it down below. Have a good day.